turning to the advisory for retirees, this budget has landed in a nervous market. Inflation is high, shares are volatile, and the hunt for safe, reliable income is back on. So how should you be thinking about locking in an income for life? And is now the moment to do it. Joining me in the studio is Justine Marquet from Allianz Retire Plus. Justine, welcome.
Thank you, Anna.
So the budget has rattled a lot of retirees. How has that changed what they want from their money?
I think we're definitely seeing a shift around portfolio construction to seek out more secure income producing assets, and sticking to more of a pure growth play is becoming less prevalent. That alongside the market volatility, the continuing geopolitical risk, rising cost of living, all of those things are really driving investors and financial advisors to seek out more diversification, more security, particularly in pre-retirement and retirement portfolios.
And the budget made changes to the capital gains tax, of course. Is that changing the way people are viewing property now?
Yes, it is. I note the news today around some potential changes even to property investments in SMSFs with the proposed Greens deal. But just in general, I think because of this, the CGT changes and the unknowns that are associated with that, and also not just the reduction in the 50% discount or removal of that, but the minimum 30% tax on disposal, where a lot of people had proposed to hold on to property and then potentially sell those investments once they're in a low income environment when they retire, has meant that people are seeking to find alternatives or to get some age pension, because of course people who have some age pension will be exempt from that minimum 30% tax on disposal.
And with rates still being high, do you think a lot of retirees are tempted to wait before locking in that income annuity? And is that the right call?
I often get this question. It's a really good question, and I think it makes sense because no one wants to sort of lock in an income rate for a lifetime product where they think that the rate might then increase again just after they've invested. But the reality is that lifetime annuities, they add so much value and resilience in a portfolio, of course, and we get all of that protection against sequencing risk and market risk and running out of money. But they're priced on long-term yields. They're priced on the 10-year government bond yield. And 10-year government bonds they're already pricing in future expectations around rate changes. So those that are keeping an eye on the RBA current cash rates and eyeing that off are really doing themselves a disservice by waiting. They're sort of removing that opportunity to get some certainty for what will probably be very little upside, because these 10-year yields have already priced in what's predicted to happen in the long term.
And do you find a lot of people are assuming that it does just follow the RBA cash rates?
I think so, yeah, I think so. But we of course know that as a provider of lifetime income streams, that long-term bond yields are what we price using, and markets react very quickly to changes in these long-term bond yields, and so it's really important for everyone to be aware of that. Things can change quite quickly, and we saw a little bit of this in mid-June. You might recall when there was a bit of a softening around the inflation environment and some of the geopolitical risks, the Iran-US peace talks started happening. What we saw was the US 10-year bond yield dropped to a 1-month low, and the Aussie 10-year dropped to a 15-week low. So markets react very quickly around the longer term proposition, and so waiting for those changes to happen, you're often too late. It's better to secure in a really great environment now. You don't have to start taking income now, but if you can secure and take advantage of current yields and current lifetime income rates, you can lock those in for a future income stream.
And I understand you have a product called AGILE, and is that what that basically does?
Yes, that's right. So it's guaranteed income for life from Allianz Retire Plus. And like other income streams, lifetime guaranteed income streams, you're securing a rate that won't decrease. It will be maintained for the income for life. But the difference with some of these more innovative income streams, and particularly with AGILE, is that you can secure that rate now in this fantastic environment, but not have to take the income until later. But the underlying investments can still grow. So what that means is, by making small adjustments to your current portfolio, still can access growth, still can access lump sum amounts. So you're not locking up your capital. But what you're doing is securing this future floor of income that helps fund essentials during retirement and just gives you that security and confidence. And that in turn enables people to maybe invest more aggressively or more dynamically with the rest of their portfolio.
So Justine, what would be your takeaway piece of advice for advisors and investors at the moment?
Focus on long-term outcomes, not short-term environment, absolutely. Take advantage of the current yields and lock in a future lifetime income rate now. That will avoid future market uncertainty, interest rate uncertainty, and if you do wait, be aware that you may be then retiring into a different yield environment, and you may have missed what is a real great opportunity now to take advantage. But either way, these products really can add value, more income, more sustainable income, and in fact, often more assets left over because you're preserving your other assets by incorporating lifetime income into your portfolio.